Good morning. Welcome to Stock Market Today. It's Friday, November 1st, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email where you can get daily stock ideas for you to consider in your inbox every trading day before the market opens. Happy Jobs Day today. But first, let's recap yesterday. U.S. equities finished lower in Thursday's trading, with the markets focused on U.S.-China trade headlines. Utilities and comm services were the only sectors to finish higher on the day. Treasuries extended their post-FOMC rally, and the dollar was weaker on the yen cross, but little changed against the euro. Gold up 1.2%. WTI crude down over 1.5%, but off the worst levels of the day. And as we get here to the desk this morning, we got the non-farm payrolls report. And it looks like the U.S. economy added 128,000 jobs in October. That was ahead of consensus estimates of about 90,000 jobs. The unemployment rate, 3.6%, was in line with consensus, and that caused the quick spike in the futures. Futures trading up 40 basis points here this morning. Asian equities were mostly higher overnight, with China up nearly 1%, though Japan did lag. European equities are seeing moderate gains. Treasuries are weaker after a big rally over the past couple of days. Dollar is stronger on the yen and euro. Gold down 50 basis points. WTI crude up a little over 1.1%. And as we look at the structure of the S&P 500 here, we are holding the breakout level. And what's interesting to me is the past couple of days, the market's pulled back to try to test that breakout level and only to rally to close off the lows of the day. So some encouraging near-term trading. I tend to be more of a trend follower. Don't get too caught up in the day-to-day action, but I have to take notice when attempts to push the market lower fail. Key support at the 200-day moving average at 28.85, then the August lows. Those are the key levels. Those are unchanged for the past couple of weeks. Near-term support, should we see a pullback, is really the gaps that we've been highlighting around the 2950 level. Call 2950 to 3000 a zone of support, if you will, with those gaps really playing a big role should the market decide to pull back and begin to test support level. RSI remains in bullish ranges, and Chaikin money flow has turned bullish with the market breaking out through the resistance zone. Now, let's turn to our market in a minute. Trade headlines sent stocks lower on the day. That was yesterday, but we just talked about the fact that we were able to kind of bounce back. But it was those comments out of China yesterday about not really being able to foresee making a long-term deal with the U.S. that really weighed on the market. The key themes that we look at point to less risk appetite, which is kind of interesting, is the SPY trades near the highs. Homebuilders do remain leadership, though. That's an area where we've been focused, and we'll take a look at what that chart looks like a little bit later in the show. All eyes are going to be on the non-farm payroll report, which we just touched on. Obviously coming in better than expected, causing a near-term spike in the futures market. We'll see how that plays out throughout the day. And as I said, futures do point to a higher open here today. Taking a look at the power bars now for the major indices. The Dow was down 50 basis points yesterday, 3 bulls to 7 bears there. S&P 500 gave back 27 basis points, 110 bulls to 95 bears there. It's a little bit of a weakening in the ratios. NASDAQ was an outperformer, actually closed up 4 basis points on the day, 29 to 18 bulls to bears, and there's your underperformance from small caps, 623 bulls, 333 bears. And I really think that this relative performance on small caps is there seems to be a correlation between the small cap relative performance and what we're seeing in yield. So continue to watch that. As yields rally, small caps come under pressure on a relative basis. And there's your rally. Second day in a row, big rally in bonds, sending yields lower. Be interesting to see how that plays out here today following this non-farms payroll report. Treasuries do appear, from a yield perspective, to be building a base in between 1.5% and resistance at 2%. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major markets across the board are mixed. Hitting our stock of the day now. Auto-generated based on its Chaikin Power Gauge rating. It's OraSure. OSUR is the ticker symbol there. Comes to us from the Healthcare Equipment and Supplies Industry Group. Stock closed at $8.54 yesterday, down 23 basis points, but OraSure has a very bullish Chaikin power gauge rating due to a very attractive financial metrics, very strong earnings performance, and very strong price volume activity. So when we take the 20 factors, 5 in each of these 4 categories, we come out with a very bullish rating. We have a strong trend as the stock is now rounding and is above the long-term trend line, and it's in a strong industry group. Healthcare equipment is a strong industry group. What's interesting to me here is we have a bit of a personality change going on. What we describe as a personality change is when a stock goes from being bearish or neutral to then being persistently bullish in the rating, and that's what's happened here. Starting in September, power gauge rating has been bullish, and since that time, we've seen relative strength go from severely underperforming the market to kind of waning, right? The weakness is waning, and now we're starting to see some slight outperformance here, and that's coinciding with bullish Chaikin money flow readings. Now, we're middle of the road on the overbought, oversold indicator, but this is a stock that starts to look interesting to me, right? Clear downtrend, starts to see a change of trend on an absolute basis, coinciding with a change of trend on a relative basis. If we can start to see really improving relative strength here, all else being equal, this Orashore starts to look interesting to me. If you're more aggressive, I can't argue with taking a look at it here today. If you want to be a little bit more conservative and give it some time to play out, maybe wait for that oversold condition, I can't argue with that either. You have to know yourself as an investor. But this is an interesting name to be watching. Mindful that it's under $10, but really interesting name to be taking a look at here. Take a look at OSUR as a potential bullish idea. Let's look at our sector tracker now. Movement in the major sectors over the last 5 days. Healthcare at the top of the list, and Orashore is a healthcare stock. Second biggest weighting in the S&P 500, behind only technology, which is in the number 2 slot. So nice to see these 2 groups leading over the past 5 days, joined by comm services. Materials, financials, and industrials are also higher. Discretionary and staples lower over the past 5 days. The bond proxies have been under pressure as rates have been stabilizing. Those are your utilities and real estate. Staples, a little bit of underperformance here, and energy back to the bottom of the list. I feel like we've beaten this horse on energy, but the fundamentals are the fundamentals. The model is the model. It's a bearish group. They tried to rally last week with a little bit of a cyclical rotation, but there are probably better areas from a fundamental standpoint to take advantage of the cyclical rotation should it continue. Energy just does not look like a place where I want to go hunting for bullish ideas just yet. However, one of the areas where I do want to start thinking about bullish ideas is our industry in focus, bank services. Now, it's been an underperformer over the past 6 months, lagging the S&P 500 by 4.25%. However, look at that power bar ratio. It's very strong. 46 bullish or very bullish stocks for only one, count them, one bearish stock. Currently ranked number 3 of 21 subsectors. Moved down 1 slot over the past week. So some of the indicative names there: FNB Corp, ticker FNB, Umpqua Holdings, UMPQ, and Essent Group, ESNT, all with very bullish Chaikin power gauge ratings. Now, you've heard me talk about the financials. You've heard me talk about the banks coming on, especially as capital rotates out of the REITs. Let's take a look at what that looks like from an ETF perspective. KBE is the bank ETF, bullish ETF power gauge rating, strong trend above a rising long-term trend line. Now, in fairness, this has been choppy for the past year, but what we're interested in is this perking up of relative strength. Bullish rating, beginning to outperform the market, bullish money flow. Now, the fund is overbought, as is the market. This is a short-term overbought, oversold indicator that we use. Tells us where an ETF or a stock is, either overbought or oversold within the context of its trend. This is overbought, but I think that if that relative strength continues to improve, you're going to be able to find some good opportunities in the bank industry group. Let's look at what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers, still predominantly driven by earnings. Even though it has been a busy macro week with the Fed on Wednesday and the employment report today, we're still in the heart of earnings season, and that's what's driving a lot of the trading in individual names. So take a look at Abiomed. This one has been a beaten down name in the healthcare space. Reports earnings yesterday. Sentiment obviously was awful, but following the report, stock rallies 14%. Kraft Heinz KHC, another one where sentiment has been terrible. Their earnings report sends the stock higher by 13%. LKQ, in conjunction with their earnings report, also announced that they were increasing their buyback. So that sent that stock higher by nearly 8%. BWA, Borg Warner, up 6.25% following their print, has a bullish Chaikin power gauge rating, and Teleflex, TFX, healthcare equipment name actually, 5.33% to the good following their earnings announcement. Western Digital, earnings were actually okay, but it was their guidance that weighed on the stock, down nearly 17% on the day. Xylem XYL down 8.75 following their print. LNC 8.5% on their earnings announcement. Church and Dwight, part of the Staples Group, down 7.25%. Bearish rating at Chaikin Analytics following their earnings announcement. And FLIR, FLIR, loses 6.25% following their print. And remember, a lot of times these earnings prints can be in line, but it's the guidance that weighs on the stock. So when I talk about the earnings announcement or the earnings prints and the reactions, keep in mind that the earnings could have been okay, such as the case with Western Digital, but the guidance is what people are really focused on. Let's look at what we're talking about in our note today to Chaikin Analytics clients. On Fridays, we look at key themes, trends, and relationships in the market, try to get a sense for risk appetite, how investors are feeling, right? I'm not a big fan of surveys in terms of trying to gauge sentiment. I'm more interested in what people are actually doing with their money, and you can see that by different relationships in the market. One of the key relationships to see if investors are risk-seeking or risk-averse is to look at consumer discretionary relative to consumer staples, right? If you think about it, if investors are risk-seeking, right, they'd be willing to bid up the consumer discretionary stocks. Kind of think of consumer discretionary stocks as the products you want, right? Whereas staples are the products you need, where even if the economy is slowing, or even if you're a little bit more fearful, you're still going to buy your soap, your shampoo, your toothpaste, your food, right? That's staples. So a sign of risk on would be when discretionary is outperforming. And we look at this on an equally weighted basis to account for the fact that Amazon is a large weight in discretionary. So we want to neutralize that. What we've seen really since last May has been underperformance on the part of discretionary relative to staples, right? And that's coincided with a relatively choppy equity market. Now, for the past few weeks, we've started to see discretionary come on, and it bounced up to the 200-day moving average, and it actually faded. And what's interesting to me is that it's fading as the S&P 500 breaks to new highs. Now, maybe it's just a little backing and filling. Maybe the stocks were discounting that breakout. RSI appears to be shifting into bullish ranges. We're going to give this one some time to play out. What I would love to see is this ratio break above this 200-day moving average, break above this resistance area here, and hold and continue to move higher. To me, that would be a sign of risk-taking behind an advance in the equities. So we're obviously going to watch this one closely. Speaks to rotation and how you want to be positioned in the market. The market can move higher. It's really a function of who's taking us there. One of the reasons I think the market is likely to continue to move higher is a chart that you should all have ingrained now if you've been watching this show for any length of time. The semiconductors relative to the S&P 500. I actually wrote a blog post. You can check it out on our site about this last week. Somebody once asked me if I could look at just one chart to get a gauge for what the market is probably doing. This is the one I would look at. Semis on a relative basis with their momentum, right? Semis breaking out relative to the S&P 500. This is a 2-year consolidation, and we've broken topside above the 200-day moving average, and that's coincided with a bullish shift in momentum as the RSI has shifted into bullish ranges. Notice that on pullbacks, it's holding around the 50 level and continuing to move higher. So with the breakout, with the move higher in semis on a relative basis, we have a momentum confirmation. There's a positive correlation between this ratio and the S&P 500. So to the extent that this ratio continues to move higher, odds are the S&P 500 will do the same. And if we look at semis on an absolute basis, you can see a nice, well-defined uptrend off of the late 2018, early 2019 lows. So encouraging to see semis outperforming leads us to believe the market's going to continue to move higher. Now you have to drill down and see where leadership is in the marketplace to look for your bullish ideas. Finally, one of the areas where we do see leadership in the marketplace continues to be this home builder. I'll call this one the home builder supply chain because XHB is not all home builders, right? It's a lot of the companies that also factor into the supply chain. Look at the nice steady uptrend above a rising 200-day moving average, broke out of a consolidation and is holding above all while the RSI confirms in bullish ranges, and look at it outperforming relative to the S&P 500. So what I would love to do is look at the holdings of XHB, identify the bullish and very bullish stocks, look for opportune setups, and take advantage of that. One of the areas where I see an opportunity, or one of the stocks, is actually Whirlpool. That's going to wrap it up. I hope you have a great weekend. I will be back on Monday.